Hi everyone, welcome to today's webinar with Rhodium Group and MERICS. It's great to have you all on the line. Just before we begin, I'd like to go through some quick housekeeping. As you'll see, the webinar is going to be recorded and a link will be made available to members post-event. There will be a Q&A session at the end of the webinar, so please do use the Q&A function in the control panel on your screen. You could also use the raise your hand function if you'd like to put a question to the speakers directly during the Q&A session, and we will unmute you and you can join the discussion. So now I'd like to hand over to Matthew, who will be introducing our speakers.
Hello everyone, good morning, good evening, wherever you are. My name's Matthew Roos. I'm Chief Executive here at the China-Britain Business Council. And it's my great pleasure and privilege to introduce this China premium webinar with Rhodium Group and MERICS. We're going to be talking about 2019 trends for Chinese FDI in Europe and what they tell us about the future. Now we have two great guest speakers for you today. First we have Agatha Kratz, Associate Director at Rhodium Group. Agatha coordinates the Rhodium Group's European activities, leading research on EU-China relations and China's commercial diplomacy. She contributes to Rhodium work on China's global investment, industrial policy and technology aspirations. She's a non-resident adjunct fellow of the Reconnecting Asia project at the Center for Strategic and International Studies under the Simon Chair in Political Economy. Her previous positions include Associate Policy Fellow at the European Council on Foreign Relations and Editor-in-Chief of its quarterly journal, China Analysis. She also holds a PhD from King's College London in Chinese railway diplomacy, which sounds fascinating, and maybe we'll get onto HS2 and be able to mine your expertise on that subject in a minute, Agatha. And then we have Mikko Huotari, Executive Director at MERICS, based in Berlin. Mikko's research focuses on China's foreign policy, China-Europe relations, again being the strong theme, as well as global economic governance and competition. Mikko has published on China's rise as a financial power, its trade and investment relations with Europe, as well as on geopolitical shifts related to China's emergence as a global security actor. He studied in Freiburg, Nanjing and Shanghai, holds a PhD from Freiburg University, and was guest scholar at the University of California in San Diego in 2017 and 18. And last year he was appointed as one of the 15 German representatives to the German-Chinese Dialogue Forum. There we are, so two great speakers for you today, and without further ado, I'm going to hand over to them for this presentation on 2019 trends for Chinese FDI in Europe. Over to you.
Thank you, Matthew, and warm welcome also from our side. I hope you can see our screen here. Absolute pleasure to be doing this presentation for the China-Britain Business Council, and we very much look forward to our discussions. We have Agatha Kratz and our research here representing work that we've done at Rhodium Group and MERICS for quite some while together, building on the incredibly important work of Rhodium Group on China's global investment profile, including in the US, etc. Goes back to a long-standing research collaboration in the past 5 years. And this year's update was just published a few weeks ago, and we cover not only FDI, but also have digged a bit deeper into research collaborations as a key format of our business and economic relationship with China. And without further ado, I would dig into the presentation here and give you a short overview. So we will first look at data trends. Agatha will provide you with the latest figures in terms of volumes, geographical distributions, industry sectors, etc. We will then look at the outlook for Chinese FDI in 2020 and beyond, obviously a specific and special context these days. And then we give you a short insight into what's happening in the Sino-European R&D partnership space and why we think it's absolutely necessary that we look at this very carefully, just to make sure that we can preserve openness and collaboration as much as possible. And with that, I would immediately hand over to Agatha.
Thank you very much, Miko. Thank you everyone for being here this morning. I'm going to kick off with a very broad slide on China's outward FDI globally. As you see on the slide, the era of expanding Chinese outward investment is over and has been over since 2016. 2019 is the third year where we saw a decline in Chinese outbound investment through the whole world, not only in Europe, for a number of reasons that have to do mostly with China's domestic picture, actually. In China, restrictions on financing generally across the board, but including for foreign investment, and within the context of the deleveraging campaign that was launched in 2017 and rolled into 2018, have restricted financing for outward investment. On top of it, in 2016, and especially in 2017, the government put back in place very strict capital controls, which have limited Chinese outward investment into the world and including into Europe. And of course, outward investment has come under more scrutiny from Chinese authorities and regulators, especially because 2016 and 2015 had been seen as irrational years for Chinese outward investment, with that huge peak in 2016. On top of it, a few Chinese companies are probably feeling the hangover from the peak years of 2016 when they acquired a number of companies, probably at too high valuations, probably with too much leverage. And some of them are reconsidering their investment strategy. So for all of those domestic reasons, especially, we see a decline in Chinese outward global FDI, which is also the case in Europe. If you go to the next slide, Miko. So the trend is the same in Europe. Europe is not outside the trend, and this is very important to say. We've gone from 37 billion of Chinese investment in Europe in 2016 to 11.7 this year. We're at a third of the peak levels, and we're back to 2013 levels of investment. It is a huge drop, but it's also very much in line with the drop we're seeing and we saw on the past slide. In comparison, Chinese investment to the US has actually declined much more than it has in the EU. So the EU is actually holding up pretty decently because the context is one of much more restriction on Chinese outward investment. Within that picture, if we go to the next slide, it's interesting to see, and I'm speaking to UK businesses today, it's interesting to see that the UK has gotten most of the investment over the past decades, and is still one of the key destinations for Chinese investment in Europe. UK was really, and has been, the first recipient of Chinese FDI into Europe with about 50 billion in cumulated investment over 2019. And if we go to the next slide and we look at the trend for 2019, although the share of France and Germany has gone down, the UK remains the second destination for outward FDI into the Chinese outward FDI into the European Union in 2019. Now, the big change this year, however, is the fact that instead of the big three dominating the picture as they had for the past almost 10 years, we're seeing a huge chunk of Chinese outward investment into Europe going into the Northern Europe countries. That's actually to do with two huge transactions that took place this year. The first one was Amersport being acquired by Enta, and that was in Finland, and pushes Finland as the first destination this year for Chinese investments in Europe. Last year, sorry, in 2019. And one has to take into account the fact that that transaction alone is close to 5 billion. So if you've got a total of 12 billion of investment into Europe, that's necessarily going to push up Northern Europe. But you've got also a big transaction into Sweden and big transaction into Ireland, which we consider as Northern Europe in this category, pushing up Northern Europe in the share of investment. The UK, as I said, second in terms of volume, but also first in terms of transaction. Most of the single transactions went into the UK economy. Other than that, very small share for Southern Europe, very small share for Eastern Europe, as usual, I have to say, in previous years. So slightly different picture this year. If we go to the next slide and now look at the UK in particular, you're seeing here that there's been a decrease in Chinese investment into the UK, much as there's been into the EU. Now it looks enormous because of 2017. 2017 is the year when CIC bought out Logicor for as much as £12 billion. And so this is distorting the picture somewhat. If you look at 2016 levels, which was the high of Chinese investment globally, or 2014-15 levels, the UK is actually holding up pretty okay. The key transactions this year were Global Switch, continued investment in Global Switch by Jiangsu Shaguang. This has been going on for a few years, but there were 2.2 more billion euros of investment this year. Word First being acquired by Alibaba for 700 million, and CIC's acquisition of National Grid's gas distribution unit, Cadent UK, for another almost 300 million euros. Key sectors this year were therefore, and quite naturally, ICT, financial services, transportation infrastructure, and some investment in education, interestingly, showing up in our data. So we're down from 2017 level for sure, down from 2016 level for sure. But the UK once again is holding up pretty well. If we go to the next slide, I'd want to touch on one aspect of Chinese investment that has been very sensitive over the past few years with the discussion around especially investment screening, and that is the share of state-owned investors in Chinese FDI into the EU. Now you're seeing that there has been a very strong trend since 2010 of a declining level of state-owned companies within the mix of Chinese investors, especially in terms of volume. You had a dive in 2016 when a lot of private conglomerates went on the buying spree in Europe, up again in 2017 when a lot of those private conglomerates got told not to do it again. But the trend continues, and the trend comes down to 11% only of Chinese investment into Europe this year that was state-owned investors related. That's actually a global trend. We see the same in the US with 7% of transactions this year only from state-owned investors. I would add once again that the fact that some of the biggest transactions we're seeing, especially in Northern Europe, being private investors, ENTA and Chinese Evergrande's acquisitions, are also a big aspect of that huge decline for 2019. Finally, in terms of sectors, if we go to the last slide, the sectoral mix is more concentrated this year than it was last year. Last year was extremely split and quite diverse. This year, we've got 4 sectors actually taking up 80% of all transactions in volume. That's once again because of the almost 5 billion investment by ENTA in Amersport, which pushes up consumer products and services as the first category this year. But you had other products, consumer product services, acquisitions such as Candy, an Italian household good manufacturers being acquired by a Chinese investor. That's actually a trend that we see as well in the US, with consumer product taking up a big chunk of Chinese investment this year. Probably, potentially, because there's less scrutiny around those investments. And that might be one of the trends we see into the future. I would like to add that, well, automotive and financial and business services are still strong components of Chinese investment, but ICT in particular, I want to point this out, remains a key target of investment. ICT sees most or the highest number of single transactions, which shows that Chinese investors are still very much interested in European tech. And they take up also second place in terms of transaction volumes. And that concerns, of course, the UK, as I said earlier. I'm going to leave it here for trends, and we can speak about that in more detail later and pass it on to Miko.
Right. I'll try to provide you with an outlook here on what we think is a likely outcome of also the COVID crisis for Chinese outbound FDI. And obviously, the core message here is, we have this debate about a potential buying spree by Chinese investors going forward. And we think that's possible to some extent, but there are quite some limitations in place and hurdles, both at home and in target markets that make this less likely maybe than it was in 2012-13 during the Euro crisis. And core reasons, if you briefly look at what's happening at home in China, and again, sorry, this is obviously the opportunity that everyone sees here, a massive dip in company valuations in Europe, but much beyond. We have seen these figures coming up a bit more in past weeks, but still, that obviously creates opportunities for Chinese and other investors in Europe and beyond. But at home, and that's the core factor here really, capital controls and domestic financing conditions remain tight, and that makes it difficult for Chinese investors to go abroad and buy assets, distressed assets, or fire sale assets that might be on the market. These figures here indicate that simply liquidity is scarce in China, and as we heard from Agatha earlier, capital controls still bite. So there are some restrictions for Chinese investors to go abroad these days. Also, if you look at this indicator here, it's the value of announced and number of announced deals. You see that 2020, and that's the last two bars here really, are basically a historical low in terms of the overall announced M&A deals. And therefore it is less likely that you would see a massive spike and increase in 2020 and going forward. Still structurally, I think, we both agree, Agatha and I, that the story will continue. There's good reasons why Chinese investors will continue to go abroad, and particularly also target European partners and assets. So a lot of this is really related to uncertainty in the business environment, uncertainty back home in China, but also uncertainty with regard to one development in Europe. And obviously, as you all know, we have a change in the landscape of investment screening regimes across Europe and the OECD world more broadly. We've listed here countries that have strengthened, and obviously you're much better aware of the changes in the UK. We've listed countries and the changes in Europe that they've engineered with regard to their investment screening mechanisms. And this is quite a dramatic shift. I would still say it's a rational and pretty liberal landscape. So all of the new restrictions and complications that we have in place are tolerable. We have indications that processes for managing the inflow of investments have become more complicated in many cases, but fundamentally Europe and obviously also the UK remain open for Chinese investment, and that's probably well considered. But clearly, we have uncertainty and complications on both sides. So in total, our outlook for Chinese outbound investment is structurally the story will continue, but there's quite some hurdles and potential complications that we have to take into account. With that, I hand back to Agatha for an introduction of what we think is an amazing topic and one that is quite related to FDI transaction, and some huge potential in there, but also some limitations that we want to tackle briefly. Agatha.
Thanks, Miko. For our joint report this year, we focused on Sino-Europe and R&D partnerships. The reason for that is, as we see equity transactions coming down, as we've described over the past 17 slides, new types of interactions are emerging. New types of non-equity, especially, interactions are emerging. Some of them have actually the same effect as FDI to a certain extent, because they allow for sharing or transfers of technologies across borders between China and the EU. And so they're important to take into account here because they are somewhat related and somewhat similar in some respect to what we had been monitoring over the years. I think it's important that we mention them as well because they're very much, or they have very much gone under the radar for a number of years, although they've grown very quickly in Europe and in China. They are not covered by most of the policy scrutiny that Miko just mentioned, from export controls to FDI screening regimes being tightened throughout Europe. But they're also not covered much in academic or broader research, and they raise little awareness so far in Europe and in other destinations. What we want to say here, and it's really important when speaking to businesses such as yourself, is the fact that most of it, many of it, are completely fine and completely okay. A first reason is that they're really natural for China at China's level of development. For Chinese companies to be looking for R&D partnerships with European partners is a very natural move. And it's actually a move that we see across the OECD. A lot of the OECD exchanges in technologies actually now take place and take the form of non-equity tie-ups, R&D partnerships, licensing, patenting, for example. And so what we're seeing here is a very natural development as Chinese investors get more sophisticated, and as they trade in higher technologies across the board. Most of them are also absolutely benign in terms of the tech that's at stake, in terms of the partners involved, and in terms of the commercial motivation behind it. It's once again, very natural, very common for companies to tie up either with universities, other firms, or even government to develop new commercial products. It can actually be very beneficial in a number of ways. The first one is that by partnering with Chinese companies, European companies can understand how to penetrate the Chinese market better, and vice versa, of course. There's a lot of human resources in China that can be leveraged as well by European companies, or a lot of Chinese companies that are leaders in their own fields, and for which European companies would be interested, of course, quite naturally, to partner. And I think in terms of COVID and with the COVID-19 crisis here, I think it's very, very obvious and very important to remember that some of those tie-ups, especially when they touch upon broad national goods such as health, can be extremely important. Now, we do underline in our report two concerns that we do think are worth mentioning, however. The first one is concerns related to security and the transfer of dual-use technologies. Second one is tie-ups that will implicate European companies in R&D sharing or in partnerships that pose human rights issues. So we're gonna dive into that quickly. I just want to say that the report, which I invite everyone to read, of course, only looks as a subset of those R&D partnerships. We look at what Chinese firms do in Europe with diverse European partners, with firms, with universities, with governments. But of course, a lot more takes place outside of Europe, in China, in other countries. And some of it might also implicate other Chinese partners than firms, or into governments, of course, and academic institutions. I'll leave it here to Miko to wrap this up and open the Q&A.
Thank you. Again, this is really just an invitation and not an expectation that you are able to digest our tables here quickly, but it is relatively easy to collect information about potential tie-ups in the R&D space that raise security, military concerns with regard to dual-use technologies. And that's true across Europe. So if we've singled out a few cases here, this is simply to raise awareness and obviously to also contribute to a debate about these issues, with the purpose to make sure that we identify red lines where we think things are potentially problematic, to avoid knee-jerk reactions and to make sure that we can continue to have a potential collaborative and productive relationship in this space. Obviously, the whole new emerging technology space with regard to AI, biotechnology, additive manufacturing, machine learning is a space that is potentially sensitive and contested. And it's worth looking in detail at the associations that companies and research institutions have, for instance, with the Chinese military. And it very often is under the radar. In some cases, the companies or institutions on the European side are not aware of what they're doing and who they are partnering with. And it's absolutely essential that we get a better picture of what's happening in this space, and be it only to manage reputational risks from a company perspective, obviously quite sensitive these days. So this is a list of examples. There's a much wider set of data available on these issues. Second is potentially even more sensitive, I would say, and its involvements with regard to technologies, R&D partnerships that serve or can serve the purpose to increase the capacity of the Chinese state to engage in mass surveillance and control. Obviously, this has a strong component with a view to what's happening in Xinjiang, but also potentially with a view to what's happening in Hong Kong. We've again selected a few cases: video surveillance technologies, facial recognition, and genetic research. All of these lend themselves to being potentially sensitive and obviously worth to be clearly aware of what we're doing and what the red lines should be or can be in these spaces. With that, I think we can conclude here again. Looking at this R&D space, we need to be aware that there is movement across OECD countries, certainly pushed to some extent from Washington, that anything that is related to dual use and human rights issues will receive much greater scrutiny, be it through investment screening or export controls. But the whole R&D space is sensitive and will get greater attention, so it's worth to be prepared for that. Second, as we said earlier, it's absolutely essential that business and liberal sectors of societies and policymaking avoid knee-jerk reactions from the national security community to make sure that we stay open for non-problematic interactions. Third, it is, talking to friends in London here, essential that EU and UK policymakers stay on the same side on this issue, but also beyond that, partners in Japan, South Korea, Australia, Commonwealth, Canada, and the US obviously as essential. It would not be beneficial for everyone in the long run to engage in a regulatory race to the bottom, or just to be on a totally different page with regard to these issues. Finally, companies have a clear role to play in this, ramping up their due diligence efforts, because it will save them quite a lot of problems going forward. And we will have to make sure that we have a right set of data and information available for these issues. And we hope that we can contribute to these needs. So that's it from our side. Quick overview on investment and R&D partnerships. And we very much look forward to the discussion with you. Thank you.
Thank you very much indeed, Mikko. Thank you, Agata. That was a great introduction to the subject, very rich and full of data. Of course, we expect nothing less from Rhodium and MERICS, but they're very thought-provoking. Thank you. So now we're going to move into the Q&A phase of the webinar. I see the first question has already come into the Q&A function. That's great. Please, everyone, do use the Q&A tab at the bottom of your screen to alert us to your questions, or you can use the raise the hand function as well. The first question is from Grant Doherty, who's asking about the potential impact on FDI from China on difficulties, changes in bilateral relations between Western countries and the Chinese state. I mean, this predates COVID, of course. It's been building for some time, but certainly since the beginning of the COVID outbreak in Wuhan at the beginning of this year, there's been much greater skepticism in Western political and media circles about the wisdom of engaging with China. Mikko, you've mentioned screening mechanisms already. How do you see this trend developing? Is there any survey evidence, for example, that it's beginning to have an impact? Early days, I appreciate that.
Right.
But anything you could share on that front would be very interesting.
Thank you. On your specific question on the impact of investment screening mechanisms, it's more anecdotal evidence, and we know that the numbers of cases that are being scrutinized by authorities across Europe remains pretty high and has increased, and creates quite a burden, by the way, on these authorities and the bureaucracy supporting it. And this has led and leads to delays in investment approval. And I expect this to go forward and actually become more of a situation. Obviously, what I can say more broadly, and that's not survey based, but I think it's quite evident that we've seen a shift past 2-3 years across Europe that is looking at greater concerns with regard to the political and economic trajectory of China. And that's the reason why we have this debate about investment screening. It is simply a recognition that convergence is probably, if at all, very slow, and that our understanding of OECD norms and principles is something that is not necessarily shared by Chinese policymakers. So the recognition that China is not a security partner, and that business practices, including with a view to reciprocity, fair competition, etc., remain at least contested. I think that's clearly has had an effect on many of our FDI policies across Europe, and that's unfortunate. But I think it's quite directly related to our changing understanding and realization of what's happening in China. And I would expect that, given the relative liberal approach that we still choose across Europe in our investment screening mechanisms, that this is reversible, or at least that the principled openness that we still communicate as the dominant mode of engagement with China remains to be the situation. But as you said, and I'll leave it to Agatha to maybe improve on what I've just said, COVID is another indication of the slowly increasing distrust, or sometimes rapidly increasing distrust, with a view to certain Chinese practices, and that's certainly not going to simplify business relations going forward. Agatha.
Thanks, Miko. I agree with you on all of those points. I want to raise two slightly more optimistic ones, just for the audience, and to keep the banner of cooperation going. First one is investment screening regimes are important, and they're an important barrier to some extent. As you said, Miko, numbers of cases are increasing, but I think our investment screening regimes in Europe remain pretty liberal. Many of European countries don't have an investment screening regime, and those who have are still in a position where their screening criterion are actually more liberal than a lot of what we see in Japan, for example, in the US, some parts of Australia, Canada, etc. So we're still on the liberal side of the spectrum here. In addition to that, I would say that key determinants for Chinese investment into Europe in particular is, of course, investment screening regime and how much of the regulation is blocking inward investment, but also business environment overall. I would say that the UK is still receiving a huge chunk of Chinese investment into Europe, despite an investment screening regime that was actually strengthened over the past few years. So that's a good sign that if you've got a good business environment, you've got good companies, and you've got a good business relationship, that's helping a lot. I would say that the politicization of investment is also a very big factor, and that actually hurts Chinese investment into the US, for example, much more than it does into the EU. We still have a pretty much open stance in Europe, despite what we're speaking about, despite the past couple of years. And so when you see the US and the deterioration in US-China bilateral relationship, the dive is much bigger. The trend of outward global investment, Chinese outward global investment, is pretty much the same as in Europe. So we're just affected by what's happening in China. But in the US is affected much more, and that's because of the politicization of the relationship. And then lastly, I wanted to say one point about the fact that actually two-way investments continue to be pretty vibrant. We had one slide which we didn't have time to cover, but I don't know if you want to go, I don't know if you can go to it. Yeah, just before that one. Yeah, here you go. 2019 was actually a pretty good year for European investment into China. It was at a 5-year high, showing that European companies, despite all of the increased scrutiny over the past few years, are still very much interested in collaborating with Chinese partners, the Chinese market. So still a little bit of optimism, but I think we need to be realistic about the risk, and that's what we're trying to do, year after years with the reports we put together.
Great, thank you both for those answers. That's very helpful. Now we can, if Grant would like, activate his microphone in case he wants to follow up on any of that. Just if Grant would like to do that.
I'm very happy with those answers.
Okay, great. Thanks. Thanks very much, Grant. In which case, we'll move on. And the next question is from Eamon Wang from KPMG, who wants you to get more granular with information about specific sectors. But let's use the wonders of technology and see if we can open Aman's microphone so he can ask his question himself. Are you there, Aman?
Can you hear me?
Yes.
Hi, yes, we can.
Hi,
Go ahead.
Matthew. Thank you both for your very wonderful data and presentation. Very interesting. My specific question is more around you. You mentioned there might be a potential buying spree from China for opportunities and assets in Europe, which I agree. I also agree with the restrictions both in China and increasingly in Europe, as we have mentioned about. Combining the sectors, what sort of sectors would you expect more transactions to happen in the short to medium term than others, if any?
Right, Agatha, I think it doesn't matter. So you want to go first?
Yeah, I'm happy to take that. I think there's two trends at play here that I want to describe, and then Miko can add to that. The first one is the longer term trend that we're seeing in the numbers, and the fact that auto remains a big sector, and we're expecting it to remain a big sector of EU-China interactions in both directions, actually. We're expecting as well infrastructure to remain a sector of interest. The problem is that it is getting more and more sensitive, but it's been a big chunk of Chinese investment into Europe, and we would expect that to continue. What was interesting last year, in 2018, the numbers for 2018, which we were speaking about earlier in my presentation, is that 2018 didn't see mega deals the way that we saw this year. And so you had a good picture of what, in terms of single transaction, was of interest to Chinese buyers. And when you look at that picture, which is a pretty good picture of Chinese interest, new key sectors with smaller size transaction emerged. Biotech, financial services, business services, ICT is still a very big sector, which I think are still gonna be of much interest after the COVID crisis, because there are new sectors that are emerging in China, and therefore it's really natural for Chinese companies to be interested in purchasing European assets in these categories. So, you know, high-tech sectors of all kinds across the board, ICT, biotech, and then the traditional sectors to remain strong. On top of it, and that's more of a short-term consideration, I would still think that at least for the next 12 months, we're going to see a lot of scrutiny around what you could term essential goods, pharmaceutical, food, all kinds of critical value chains. And then technological crown jewels. I think any attempt to acquire kind of a high profile company in Europe considered to be a crown jewel in whichever their technological sector is, will be scrutinized very, very intensely. So I'm not expecting a lot of those, probably infrastructure as well, especially critical infrastructure. So at least for 12 months, I'm expecting those sectors to shrink, even if they were of much interest in the past. And yeah, that's about it, I think. Miko, anything else?
No, all fine.
Thank you both, very helpful.
Thanks for your question, Aman. Now we've got a mystery question here from an anonymous attendee, but it's on a familiar subject, the Belt and Road Initiative, BRI. And this is a topic that we've followed very closely at CBBC, producing our own reporting on it. And that's perhaps because the UK has very strong focus on welcoming investment in infrastructure and the financial services with the strength of the City of London. But you know, perhaps BRI is just a detail rather than the main story in the context of investment into Europe as a whole. So the question is how you see that landscape evolving over the next 5 years. Are there likely to be more impacts from immediate post-COVID-19 interventions, or is actually updated BRI strategy on the part of Beijing more significant in the medium term?
Very smart question, which I immediately want to delegate to Agatha, but happy to jump in later. But it's a good question indeed.
Thanks, Miko. It's complicated because I have a hard time speaking about Belt and Road in Europe, simply because my definition of Belt and Road is twofold. It's mostly lending based and it's mostly construction based. And what we see of the Belt and Road in Europe is usually acquisitions, and it's usually FDI. And so it's just I'm usually having a hard time reconnecting the two, because I think about Belt and Road mostly for developing in emerging countries, and I think about acquisitions, FDI, you know, even in infrastructure sectors are something a little bit different. Now, two points maybe to this actually. The first one is that where I do see Belt and Road overlapping with Europe is in Central and Eastern Europe, because there's been a lot around the 16, now 17+1, around infrastructure in particular, around LinkedIn 17+1 with the Belt and Road Initiative. And there's just one project here that that matches my two criteria, which is lending and construction, which is the Belgrade-Budapest railway, which is now being still talked about. Financing agreement has apparently been signed, has been set aside outside of public scrutiny under COVID-19 special law. So we don't know what the financing looks like. But in any case, 17+1, I think, is a very interesting case because in our data, at least, despite the whole publicity of the forum, despite the attention it's gotten in the press, the attention it's gotten from policymakers, especially in Brussels, the level of investment, Chinese investment that goes into the region is extremely small. Central and Eastern Europe is about 10–12% of European GDP. It only gets 2 to 3% in any given year of Chinese investment. So that's actually pretty limited. If on top of this, you add the fact that there's only one project really that is backed by Chinese lending and with a big construction project, which is Belgrade-Budapest, you really get to a very small extension or a very small impact of Belt and Road within the European Union. Now, I think Nico would be able to speak to the Western Balkan, which is a completely different story and a very, very important one to watch. But within Europe, this is a little bit different. Now, if you take typical Belt and Road sectors, however, and you kind of widen my own definition to think about logistics, construction, I think there's two things we can say about the future of Belt and Road in Europe. The first one is acquisitions, any acquisitions of critical infrastructure are going to be scrutinized, and they're going to be scrutinized really hard. I think the UK is still really open, and the fact that Cadent UK was bought out this year is a sign that the UK government is really open for business, even in critical infrastructure. But I think in the rest of Europe, most likely, those transactions are going to come under a lot of scrutiny. The other thing is we're seeing more and more an ease from European contractors as relates to Chinese procurement of infrastructure projects, for example, and construction projects overall. You've seen a few cases, and HS2 is one of those, where Chinese bidders have bid for huge projects. Some of them have won those procurement projects, and European contractors are worried and they're reacting. I think a lot of the discussion around procurement rules, a lot of the discussion about the IPI, the International Procurement Instrument, are going to aim to restrict a little bit of that activity because it's perceived as unfair. So I would think about that critical infrastructure acquisition and procurement markets in the future. And I think for both, scrutiny is going to be high.
Very good.
Just, if I can just comment on the original question, what's more important, the short term or the strategic shift? And I think they're just affecting the BRI picture in two very different ways. The COVID shock is one about liquidity and being much more careful about what's actually possible, and CDB and Exim and other financiers being bound also much more with the domestic situation. You know, probably they have to invest in shantytown construction and other infrastructure projects at home more than abroad. But the strategic picture to some extent remains in place. I don't think we see a fundamental shift in the importance and relevance of China's outbound industrial policy, as I would call it, whether it's labeled BRI or not. I do think what's interesting there is obviously the shift in sectoral priorities. So for instance, a much higher recognition of the digital Silk Road as a priority. And obviously that massive debate about sustainable infrastructure, the role of coal investment, etc. So I think we will see quite some shifts there. And these are probably more important in the long run than the current standstill that we see with regard to the financing side.
Thank you, Mikko. Let me crack on because time is pressing ahead and I want to try and get a couple more questions in. We do have some questions in the Q&A. Actually, there are two related here. You said in your introduction quite a bit about investment screening and controls leading to new approaches in terms of dual-use technologies and R&D. So two related questions. One from an anonymous attendee who's asking whether you see China favoring the route of dual-use R&D collaboration in the future, so as a kind of workaround any investment screening restrictions. And then, as I say, related to that, from Sharon Chung, who's a CBBC board member. Sharon says it's her understanding that on top of security concerns for defense-related technologies specifically, there are also additional political concerns for other non-defense related technologies that might be increasing EU scrutiny. And do you see that leading to a really significant reduction in Chinese FDI into the EU specifically? So let me hand over to you to answer those in whatever way you judge appropriate.
Can I just say these are brilliant questions and much better questions that we get anywhere than we get anywhere else.
We try our best.
No, they're really good. And Agatha, you choose. I take whatever you don't want to cover.
Why don't you start on maybe on the second question on other hurdles?
All right, good. So, you know, we've heard the responsible EU official yesterday on what the screening mechanism framework in the European Union is meant to be and what it's not meant to be. And he's very explicit about the fact that from Brussels' perspective, this is about national security defined in a very narrow way and about immediate threats to public order and security, and thereby, you know, not covering any other issues. So that's the formal reality, and I think it holds. It will be difficult and also contestable in courts if investment screenings go much beyond that in the European landscape, EU landscape to be more specific. Now, obviously, there is a political reality in addition to that, and there are ways to use informal measures to prevent certain transactions, and that has been the case already in Germany, for instance, and not necessarily related to political considerations, but simply an understanding that there's a different interpretation of what a threat to public security and order means. So the debate in Germany, for instance, apologies for talking about this sitting in Berlin, is whether already the possibility of such a threat, for instance, is something that should be covered by the investment screening regime. And there's a debate about this in Parliament next week. And that obviously opens the door for a much greater degree of politicization of all of these deals. What I can say is, I think, and it's pretty obvious, we are entering a new period of thinking about Chinese investment, and it has much more prominent political overtones. And there will be ways and means beyond the investment screening mechanism proper, or even inside of it, to complicate some of the deals if they raise political concerns. And they can be related to competition, they will be related to sensitive infrastructure, but also to an expansion of that idea of strategic autonomy in the tech and digital space. Now, without any judgment, I think it's a reality that this will happen and is happening already. So I think the question is exactly on point. This is something that is real and we have to take into consideration. Agatha.
Yeah, just three very quick additions to that. The first one is looking across the Atlantic. We see new definitions of national security emerging with much broader scope, especially including economic security. We're not there yet, and I think that's not at least from what we heard yesterday in particular, that's not where the EU or European governments overall are yet for sure. But thinking about economy as part of your national security is really something that's now being integrated into the debate. So important to note it and to follow trends there very closely to see if the debate and see if arguments are going towards that direction. Strategic autonomy, Miko, I'm glad you mentioned it. And I think in COVID time on top of this, all kinds of essential goods are going to see a lot of scrutiny. I think acquisition of agricultural land in France or the UK or Germany for that matter are going to come under scrutiny. Any kind of pharmaceutical acquisitions is still going to come under scrutiny, even if it's completely natural, commercially oriented, etc. So we at least COVID has opened a new door to thinking at least a little bit about national security as an economic security concern. So that's one thing I wanted to mention. The second point I want to make is on this issue of circumvention and whether or not R&D partnerships are used to circumvent investment screening regime. I just want to say that this is extremely hard to say because we can't prejudge or we can't judge of Chinese actors' intention in the way that they behave, especially if you're data focused in your approach, the way that we are. There's two things there. I think the first one is it's normal and completely natural to see an increase in R&D collaboration, and there's nothing surprising here. And so we need to keep that in mind when we start looking at R&D collaboration, not to be too negatively focused on what could be security or strategic issues. Same way as the fact that a lot of Chinese investment into Europe concerns made in China 2025 sectors is simply because China's economy at this point in time is focused on made in China 2025 sectors. So it's really tough to assign, once again, intent when we look at investment. Now, when we set that aside, we haven't mapped out R&D partnerships in Europe. We're hoping we can do it with some funding one day, Miko. That would be excellent. But we have looked a little bit in the US and in the VC space in particular at Chinese transaction in the US. And when you look at the patterns of investment, in certain very specific cases, and I'm saying here very few cases, you do see patterns of aggregation of certain Chinese investors to stay beyond the radar. So you see different Chinese investors buying small stakes in a company that might raise scrutiny, keeping each at say 2, 3, 4% investment stake to circumvent investment screening regime. But I'm not sure, and I really don't want people to think that R&D partnerships are a response and direct response to investment screening regimes. They're not. They might be used for doing so, and that's sure, but they are not a response to that. The last thing I want to mention that will be interesting to look in the future is as investment into the US, Chinese investment into the US dwindled down to almost zero at first quarter of 2020. How much of those flows will be diverted to Europe into technological companies in particular through R&D partnerships, through VC and through investment, because a lot of China's investment into the Silicon Valley is not happening anymore, or much less of it is happening. Barriers are going up, and so we're probably going to see even more of what we're seeing today into the future.
Great, fascinating, isn't it? Thank you. Now we've got about 5 minutes of Q&A time left. I'm going to, with apologies to everybody else who's in the queue, ask James Brodie to go next. James is based in Scotland, which has been very focused on green issues in recent months, because of course Glasgow was due to host the COP26 Conference of the Parties, now postponed, but we hope it will take place next year. So James, do you want us to activate your microphone so you can ask your question yourself? Let's try and do that.
Sure.
If not, there
Thanks,
we go.
Matthew.
Go ahead, James.
Yeah, my question is just how much of an impact have you seen on investment flows from China to the EU and vice versa of green issues, sustainability, climate change narrative? And how do you see that increasing or decreasing over time?
Thanks. Who'd like to answer that one?
Very briefly, Agatha, and tentatively, again, brilliant question, very important going forward, I think. And I think what we can say is that we've seen a sustained interest in clean tech, green tech, but also in renewable energies across Europe. and interestingly often by long-term investors, CIC for instance. I think that is an old story already, and it's quite sustained and continues to be the case. Now, what's going to be more interesting really is at one point, and that depends a lot on the political environment in China. At one point, this greening the economy narrative will create a more massive, sustained push for outbound investment in relevant technologies. You know, we have a few cases already in waste incineration, for instance, a quite big deal in Germany 2 years ago, where we can see that, and I think it's a story that is going to continue to go forward. It's not a massive trend, but it's relevant. Agatha.
Yeah, completely agree. We actually, in that particular case, Central and Eastern Europe was a big field for investment in renewable energies over the past few years. Very, very important investments there. Not so much acquisition, although there were some of those, but setting up of wind or solar farms, which were pretty promising. So that's one thing I can say. Otherwise, I mean, it's not a big trend. We don't see an uptick that is significant in terms of climate or environment-related technologies or sectors. We just see occasionally some cases that are very interesting ones to look at. So, you know, we should probably, maybe next year, Miko, in our special topic, focus on that and see what you can find.
Yes.
The other thing I want to say that is anecdotal, but I wanted to mention it. We've been discussing with a number of energy companies that, well, because of joint venture or other market barriers in China, just can't be in typical kind of non-renewable energies on the field because the barriers are so high. And so where they're welcome and where they have a competitive advantage is in new technologies around energy, cleaner technologies around energy. And so that means that actually quite a bit of what we see the other way around is also new cleaner energy investments. It's a good trend, but it's also a trend that is just the fruit of lack of openness in China. So good for the moment. We'll see also if barriers, as Chinese companies get better at new tech and better tech for energy, cleaner ones, if barriers get increased simply because Chinese players are able to deliver. But for the moment, this is creating an opportunity, I think, for European players.
Great. Many thanks for your answers on that. We're going to be drafting a report in advance of COP26 next year, so may well come back to you for more data on that. Thank you.
Right.
Yeah, don't hesitate.
Thanks, James. Thanks for the question. And that's brilliant timing because we're right on the dot of 10:55, which was the scheduled end of the Q&A. Thank you very much for responding to those questions so fully and carefully. That's great. So I know some people need a hard close at or before, ideally 11 o'clock. So we will be wrapping things up shortly. I think it remains for me to thank both Agatha and Miko for sharing their expertise so wonderfully in that session. It's been extremely thought-provoking and insightful. As we said at the beginning, we are going to be making a link available to all participants so that you can access the recording and view this again. A lot of very valuable information there that I'm sure many of us will want to review. So we will be getting that out. We should give you both a chance to tell us where can we get hold of the report for those of us who want to see the full picture.
Thank you, and we're not good at marketing, obviously, and I think we'll share with you the link and make sure your premium members have access to it. And if I'm quick, I'll be able to put it into the chat here, so you could share it directly with colleagues, and that's done right now. But I don't know if that's the way going forward.
Yeah, my chat button is flashing, and I can see there we are. There's a link for members to access the MERICS website, merics.org, and the PDF is available there, which is great. Thank you for that.
Yeah.
And while we're advertising, thank you, Isabel, for popping up on the screen. Those two upcoming webinars, two important opportunities next week. On the 5th of May, which I think is Tuesday, if I've got that right. His Excellency, the Ambassador of the PRC to the UK, Mr. Liu, will be talking to us about UK-China relations in the context of COVID. So there you are. You couldn't really get more current than that in terms of a hot potato issue. So we hope that many of you will join us for that. And then the following day, on Wednesday, Wednesday the 6th of May, rather, we have a webinar on COVID-19, the road to recovery, an update from Shanghai by our friends at KPMG. You'll recall that KPMG shared with us their learning and experience of going into the COVID-19 outbreak in Shanghai, and this is an update to that, so that proves to be fascinating. Please do register for those two events if you haven't already. My chat button is just flashing again, so let me just see if I've got any messages from my colleagues of other things I need to say. No, so in that case, I think without further ado, we will sign off. Thank all our participants. Thank Miko, thank Agata one more time. And everybody, please take care, stay safe. These are weird times that we are living through, but isn't it wonderful what we can achieve through the medium of webinar? Thank you all very much indeed.
Thank you so much. Bye-bye.
Thank you.
Bye-bye.